Thanks for putting on this great event. I was thinking about this last night. This is kind of a cool thing for me. 21 years ago, this fall, in the fall of 1996, we started grad school together. And looking back on my career, I've never had the opportunity. There's lots of successful classmates that we've had over the years, and I've never had the opportunity to present one as a keynote speaker. So it's kind of cool for me to do that tonight. When I first met Alan in the fall of '96, there was no question in my mind that he was going to be successful in life and in career. A few things he had: he was very smart, like a lot of my classmates. He was humble, and he was hardworking. Hardworking stories at Stanford Business School go like this. 80% of the people are out playing golf on the Stanford golf course. I won't mention any names, of course. And then 20% are actually preparing for their cases for classes tomorrow. And Alan was one of those guys. So he was definitely hardworking at business school, and he's gone on to join Vista in 2001 and really build what I think is the global powerhouse in tech buyout today. They've done amazing deals like Marketo, Ping Identity, Granicus, WebSense, Reynolds & Reynolds, the list goes on. And they've done a phenomenal job in both finding and identifying those investments, executing them, helping build the companies, and then exiting them. So it's really been cool to follow Alan's career, and I'm really excited to have him here tonight. So welcome up, Alan.
Thanks, Kurt. And I appreciate the fact that you didn't go the other way in the introduction, which would be talking about the fact that we didn't have class on Wednesdays, and we were both members of FOAM, which is called Friends of R.J. Miller, which is the academic award you get, R.J. Miller Award, if you're in the top 10%, which I was not part of. But if you're a friend of R.J. Miller, you can go to this basically party every Tuesday night because we have no class on Wednesday. So I appreciate not going that direction. So we're going to talk about a couple things, and we'll talk a little bit more about Vista and the construct of Colorado software investing. But to give you a sense, because some folks look at this and say, oh, great, I've got a Series B, I'd love to talk to you about our financing. So we're kind of after the alphabet, right, in the world of private equity. When you've gone through, you have proven that you've got product market fit, you've got, generally probably 100+ customers, if not thousands, and your P&L at least can squint and see profitability, if not already having become wildly profitable. And so those companies in our world can be of varying sizes. When we started Vista, it was 7 of us. God bless one wealthy family in Texas for giving us $1 billion. I'm not sure I would do that because collectively we had 1 year of private equity experience between all of us together, not on average. We now have progressed to where the firm has 3 active funds: an Endeavor fund, which focuses on companies, think of it as $8 million through about $25 million in revenue. I co-manage the middle market fund, which is, think of it as generally $30 million through about revenue. And then the flagship fund, which used to be our only fund, is generally $150 million up through a couple billion in revenue. We are generally taking a majority interest in the business, sometimes 100%. But it's usually us plus management is probably the most common kind of cap table. Oftentimes we're cleaning up a prior cap table, and some of these have 170 rows of investors that we're trying to figure out how to get their 10x over 11 years and then provide them some liquidity. So that's the context of kind of the world we live in. That's a little different than the venture world that most folks are more familiar with. So we'll cover a couple things today. One, I kind of wanted to give a out-of-towners view on a few things. One, software market broadly defined, and we are the most active software investor and have been for about 5 years in a row. I wanted to provide a little bit of a perspective on private equity intersecting tech and really software. 3, a view on Colorado to a degree in terms of what we're seeing. I think one of the key things, I moved from San Francisco to Austin, Texas about 6 years ago, and I got invited to something similar to this. It was probably about 150 people in the room. It was a CEO summit, and the folks had invited me because I was new to town, and I'm sitting in the back quietly, and then some comment came up about they wanted to know what was going on in Silicon Valley. And then I get cold called on the back. Alan, you just came from Silicon Valley. Tell us what it was like. And I'm like, oh my goodness. Like, one, I was not prepared for that too. Fortunately, I was paying attention, but it's dicey. My commentary is not, I don't think what they were looking for, but I think is the message that I think is most important here, which is, well, don't look at what Silicon Valley's doing, look at what they're not doing. And that, there is one Silicon Valley, and it is a wonderful place for creative creation and creative destruction, but a lot of other things come with it that aren't as positive. And I think that creates an enormous opportunity for a couple of what I would consider to be the large tier 2 cities in tech. Frankly, a really strong group of probably 6 to 10 areas that I would consider to be strong tier 3. I live in one of them. I'd consider this to be another one, where those are where the best future opportunities lie. And so I was excited to come here today to talk about that. And then at the end, hopefully we bring all this together and it sets the stage for, I think, a productive panel and some Q&A as well. So if you look at this real quickly, over 37 years, we've gone from a world that was energy dominated in our capital markets to one that is entirely dominated by technology at the top. And that changes a lot in terms of what we do and how we think about running businesses, serving customers and whatnot. I think this chart demonstrates it quite well. The second thing I'd point at is when you look at the fastest growing companies, almost 60% of the 500 fastest growing companies are software, right? This is the easiest place and the fastest place for technology to gain root and basically prove out whether you've got a value proposition. And where we sit today, even compared to 15 years ago, is dramatically better. I started a company called Fandango. We built our initial site and everything we needed to do to get live and sell tickets on the internet. It cost us a little over $3 million to do that. I could do that now for $300,000 better and faster. And so the entry point of getting into the software business has gone way down, which I think is great for the entrepreneur. It's a little tougher on the venture capital business at times because the need for capital in many instances has come down, at least the early capital. Where does this take us? I think this takes us to 2 places. So one, the software market is projected to be the single largest segment of our economy in 5 short years. And when it gets there, it's still going to be the fastest growing. Now, this is Gartner's numbers, so they're right about half the time. But even if they're only half right, this is amazing, right? From where we've come from, for where we are today, and to expect it to continue at the torrid pace. And we believe it will. This is a chart we use to think about, one, the construction of creating 3 funds inside of Vista to serve the market. Our view was 17 years ago, there were a handful of firms that were focused loosely on the growth equity, kind of low leverage buyout world in software. Our view there were two opportunities. One, that there was a world and a class of more mature software companies that actually could fit the private equity kind of LBO model in a very productive way. And 2, that a number of firms had grown up in size and left the back door open for other folks to entrepreneurially, in our world, come along and start a different firm. And so Vista was started effectively in that vacuum. And what we wanted to do is make sure that we didn't leave that behind, frankly, for others, because it's a great part of the market. So when we look at this, I'd say 2 things to talk about here. One is just the vast number of companies. And if anything, this grossly underestimates the number of software companies that are out there. This is the ones that you can find in a database. And the most amazing thing I'll find is we've probably got about 25,000 of these names in our CRM system to track and watch them grow up over time. And about 50% of the businesses we look at in any given year are not in that database, which blows my mind. I talked to our BD group. It's like, how are half of them not in there? And they're like, there's a lot of them. But I think this is good. And if you think about it, this chart is even more amazing when you look at the amount of M&A activity that occurs in this market. This is net growth in software companies, right? And this not even factoring in how many companies are successful and then find an exit selling to someone else at some point. So we look at this and we think software is the best place to think about innovation and creating value for your end customers, and therefore, given its low capital intensity and quick ability to scale the business, it's a great place for investors as well. And that's been true for the venture community for 30 years, and we believe it's been true for the private equity community for about 17 years. Now, as you fast forward, when we were going, it's probably 2002, fabulous business in another market similar to this in Portland, Oregon. Business was probably 16 million in revenue, growing about 25% a year, 50% profit margins, and Silicon Valley Bank would not give us a loan for that business. You're like, what are you talking about? 95% retention, really? No loan? They're like, no, it could go out of business tomorrow. And that was just the viewpoint. Now Silicon Valley Bank will lend to almost everyone in this room of almost any size. They've created their own set of practices. And to me, that speaks to how far we've come for a market that was presumed to not exist that short period of time ago. So this was referenced earlier. Of all private equity, almost 20% of the deals now are in technology. And so it's gone from a backroom exercise where people are not really going to talk about it because they don't think it should or could be done, to now representing a nice and meaningful fraction of all business done today. And we got started, Silicon Valley Bank wouldn't lend us. We had, I won't say no competition, but very light competition for folks looking to do these deals. We did a survey, and this is probably 2 years dated. There were 189 firms that had done a software buyout deal in the prior 18 months. If anyone thinks they have competition, try 188 other people that could come compete with you on a deal. That is where this has gotten to, and that is a 2-year-old statistic. We were a little depressed by it, so we stopped the survey. And what does private equity like about software and many other software-driven technology models? Well, it's really simple. The business model is fabulous. Where we've gotten to today with the predominance of a recurring revenue-heavy SaaS model or term license model fits the world of predictability which private equity wants, right? We're in the business of every one of our businesses needs to be successful, so therefore we can't have a portfolio approach with some winners and some losers to make up for it, because we are not looking for the 10x return on our dollar. The second is really the growth opportunity. Where else in the economy can you find large swaths of predictable growth in different markets, or new opportunities getting created with extremely high growth in companies that are going to grow up and be in our sweet spot? This is really the one that fits the private equity model. You could argue certain parts of healthcare, but I think the regulatory risk undermines that to a great degree. And energy is great when it's great, and when it's not, it's not. And so this is, in my mind, kind of fits the model extremely well. And then frankly, if it's going to be this big a part of the economy, then private equity, if it's not going to play there, is missing a gigantic opportunity. So as we look at the whole universe in the software world as it intersects private equity, this is really how we look at it. It's not going away. When you look at that, 2016, there's a lot of big deals. It's driven by a lot of trends on top of what I would consider to be really great core businesses doing the transaction processing work in lots of organizations. But these are trends that are going to transform industries and transform existing markets for software. Probably at the bottom, cloud and SaaS is still a trend. There's a lot of industries still going through it, but it's one that I would say large portions of the market are well through their recognition that it's important. But if you look at total spending in SaaS by enterprises, looking at the buyers back to where they've spent money, it's still less than 10% of the market. So we're still in the early days of what this is going to mean. And that's the most mature of all the trends. FinTech, is one where there's ever increasing evolution of opportunity for folks, and what are they going to do? For one of our recent investments, Lithium, they had a Nordic bank come in and present what they're doing. They've gone from 450 branches to 50 branches. They actually, and their goal is to go to 0. And the reason is they need to lose the asset-heavy footprint to be more competitive. And frankly, their population got smartphone savvy long before we did, and that's where everyone wants to do their banking. Technology took over their business in a massive, massive way. But it creates a problem. The problem is they now no longer have a relationship with that customer. They now no longer basically don't know who they are and what they need. They no longer have a dialogue to understand when they're having a life event, either a marriage, a new baby, a need for a new house, all the things that create the need for other financial products. So what do? They actually wisely turn to one of our portfolio companies for a technology solution. But all these trends are going to basically create further and further opportunity within software. Some of it for pure startups and innovation, and others to transform existing businesses through yet another evolution in their own business. So let's now bring it, focusing in on how we might frame it for looking at Colorado. So if you look back over, I think this is 2016, where the tech deals got done, you will see it kind of lines up roughly where you would expect, population centers and whatnot. The good news is Colorado's in, frankly, a great spot. I think strong and growing market on that front. And I think a trend you'll see continue. we may talk about this a little bit in the panel, but if you think about what makes for a great market, it's an ecosystem, right? You need an ecosystem, and there's a bunch of reasons why things have taken time to kind of get to a great spot. I would say, to really break out, you really need to have, the Hewlett Packards of the world that grow up, create hundreds of millionaires that go off to become angel investors, and they go start other companies and mentor young founders. And when you have those types of events where people want to continue the flywheel of innovation and entrepreneurialism, that's when your market goes crazy. The things that happen before that today are, strong, small to mid-sized companies that all help one another, strong networks of advisors, legal and financial, and other service providers to help startups, get rolling. Frankly, groups like Software Colorado and whatnot that are really bringing you together to kind of create this environment ecosystem to basically accomplish more than you would on your own. Those are the big things. The last thing that I would say this area would need, and Austin lacks this as well, is where's the Amazon, where's the Google, whatnot. You can be wildly successful without it, but if you get one breakout company on that front, the cascade and the flywheel will continue on its own without actually having to add any extra energy to it, which is pretty exciting. I think it's a very hard thing to predict. You've got to kind of not only have a great idea, but get hit by the lucky stick and persevere and not sell out before you become that big company. And so I think that's an important factor that's a little bit hard to control. But otherwise, I'd say, this area, the whole Denver to Boulder corridor, has done an extremely good job in Colorado in general. There's been a number of transactions of various sizes in the state that are, I think, representative of the diversity of talent and ideas that are coming out of Colorado, which I think is great. We ourselves have looked at 2 of these, and then apparently we destroyed them all. So when we think about, just putting some numbers to it, so the big numbers are tech overall. So the amount of tech private equity has nearly doubled in the last year, right? Which is an amazing statistic, because that's 17 and we're not done yet, right? And the number below is basically the software side of it, which is, almost doubled as well, kind of on a trajectory to double as well. So pretty phenomenal. Now, is that because we're heading towards a bubble? Could be. But I think it's a good underlying up and to the right trend saying that this is an important market, nationwide, and is going to continue to be a stalwart of innovation in technology. So this is a couple silly stats about Vista, but we'll put up here just for a second in terms of how we think of ourselves. And there's a couple reasons to think about this. So first, if you add up all of our portfolio companies together, we are the 4th largest software company in the world. And we treat ourselves much like a holding company because we want to get the benefit for all of our companies being that same portfolio. And that comes from sharing ideas very directly. That comes from the fact that we've built a captive consulting organization that's 90 people deep to basically help every company become the best version of itself. You get those resources to get you to the next level. And the impact is substantial. It has allowed us to, over 17 years, and most of this has been done in the last 7 years, we've completed over 280 software transactions, representing about $88 billion of all sizes. This is platforms and add-ons. The largest deals we've done have been, a handful of billions of dollars in total value. The smallest deals we've done have round to 0 in revenue. So we see a lot on that front. Now, obviously, the near 0 in revenue is a special case. It's not really what we do for a living, but there have been a few instances where our existing portfolio companies have found a technology that is transformative to what they want to do, and it's going to get them time to market by 2 years. And in many instances, that's the difference between taking the leading market share and letting someone else do it. And the most important number on the page is this last one, is our control deals, which is all but 5 of the deals we've ever done in our history. We've never lost money, right? And this is, I think, an important lesson for everyone, which is, some say, well, why'd you do that? The Harvard folks actually said it was statistically impossible to have no losses, given you have the highest returns. And the answer is, well, there's a few things. One is business selection. So we pick software, right? It's a great market with a great business model. 2, we focused only on software. So everything we're doing to help one company probably has a 50% chance of helping at least 10 other companies, right? And so that flywheel effect on our own organization. And I think, to me, if I try to extrapolate what that means, is figure out something that's worth doing, right? A big enough market, a big enough opportunity, and just get really good at that. Get really, really good and put everything you can into being really good at that. And don't stray too far. And we still do what we're doing. A lot of folks have said, well, why don't you start looking at buying some of the general industry companies that underlie that? Why don't you start doing growth equity? Now, we have done some growth equity, and there's a reason why it's only 5, because that's a hard business. And it turns out it's a pretty different business. And it's one that we wanted to stick to our knitting, and so that's why you see 275 to 5. And then if you think about what's important, and then if you get to the stage where you're thinking about private equity being relevant for you, there's a couple things I'd really focus on. One is you want to understand what's their strategy. There's tons of private equity capital out there. I mean, as soon as you have a good business and you want to think about it, you raise your hand. You go to one of 1,000 banking conferences, you'll have 25 people knocking on your door, no doubt, right? Those 88 folks I have to compete with, they will all line up, right? Because it's a great business. And so what do you want to do? You want to find someone that obviously has the cash. So always figure that out, because if you don't, you're wasting your time. But assume that's not the case. Then you want to say, what is their strategy in their own business? Does it align with how we want to run our business? Does it culturally work with us? We had a meeting a week ago with a firm that's like, hey, you guys, you're very active with your portfolio companies. I want to make sure that our cultures fit. Their culture was extremely important to them, which we appreciate. We can't do that for someone else. And so if a CEO has built a really great culture, we want to encourage that as opposed to, try to change that. I said, look, there's really there's 3 things that if your culture accepts and is part of, we're going to get along great. If any of these things scares you off, we can cut the meeting short right now, because it's not a fit for us. And the 3 things were, we focus on data-driven decision-making. We want a meritocracy. So, get rid of the political BS. And we want folks that focus on accountability. We're going to do what we say we're going to do, all of us, right? And get in a habit of doing that. And there's a few other things around transparency and whatnot that we think are also important. But if you find those 3 things aren't going to fit with your culture, it's not going to fit with us. And I would encourage you, if you're meeting someone in the private equity world, what their core philosophical pillars are, and determine if it's a good fit for you, because it's another business marriage, and it can be really, really productive as long as you get that right up front. And then where's Vista in Colorado? So our founder is actually he went to East Denver High, so he is a Denver native. I'm a Panthers fan, so shame on you guys for 2 years ago. That was a very, very long trip home with my boss. So, but we've been very active over the years in Colorado, right? It's been a handful of businesses we've either bought or invested, and frankly, a number that we're building centers of excellence here. And the reason is great tech talent. That spirit that brings up and fosters innovation for startups is actually great for companies of our size and scale as well. And there's 2 ways to look at this, and they're both accurate, so I'm not going to downplay one. One is it is competition for talent, so it's just flat, it is, right? That's a negative. The positive, though, is there is a rising tide lifts all boats as these opportunities grow up. And the way to think about it is, when you build, Marketo is building a fairly significant presence here because we've run out of the ability to hire the people we want in Silicon Valley. I've got another company on the East Coast. We went through a 5-city RFP to figure out where we should build a center of excellence for support and dev. It's coming to Denver, right? It's not gonna be huge, but probably 30, 40 people. But it speaks, I think, volumes to what has been built here in Colorado and what it will mean for not only the folks that are here today, but the entrepreneurs of tomorrow. And if you add it up, even in 4th largest nationwide, even in the footprint we have here, and this is existing employees, not counting hires we know we're going to make, and 3 other companies are bringing significant jobs here. 1,400 folks already on the ground here in Colorado. So we find it to be a very important area. A lot of folks say, well, what are you hiring? Turns out it actually maps to our org chart pretty nicely. Pretty nice mix of the functions you're going to need to run a whole software company. And as we grow up these managers, eventually some of them are going to say, hey, you know what? This has been great. I've had a great 5 years. I'm now looking for something else, and this is going to be a great talent pool for the rest of the ecosystem, you guys in the room. We're going to talk about 2 companies, both based here. and what we found attractive, just to be a little bit more specific. So the first is Ping Identity. How many of you guys have heard of Ping or know Andre? And this is one where we paid an extremely high multiple for this one, but worth it. And Andre's doing an awesome job. So what do we like? So number one, it's a market leader in a super growing market with a strong advantage and a pretty limited high-end competitive set. However, when you get to infrastructure and security, that can go away quickly if you don't keep investing. So the funny part was, right after we made this investment, I'll remain nameless, a prominent venture capitalist invested in our number one competitor, said, good news, they're going away, Vista bought them. And then someone else fortunately retweeted that and was like, yeah, Vista's totally gonna just flush it down the toilet. Their investment plan certainly includes that. Some slightly different version of that. And I was like, okay, I wanted to say that, but I'm not supposed to be on Twitter. So what do we see? We saw a great market opportunity, and if we helped Andre, who frankly is already doing a very good job, if we can figure out and help him figure out the 6 to 8 things that he can do to make his company better in the next 5 to 10 years, we can take a 30% grower that's already a good size and over 100 million and accelerate it or maintain that 30+% growth rate. We can help him do acquisitions and broaden his footprint, which we think in the long run is going to matter a lot in this business. So number one, we like the market they're in. Number two, experienced CEO. And it's, the sitting CEO is always the easiest one to back and help take the business to the next level. I don't want to say we're indifferent, but we actually have a portfolio. It's a pretty even mix of both. Another one of our CEOs is here today. We brought in from the outside because the company through merger had outgrown the current management team. Both can work, but this is obviously great. And without a great CEO already, we wouldn't have paid as much for the business, right? Because of execution risk. And the third thing is really the timing for investment. The time for investment in this company was right now. The time for Ping to go be a better version of itself was right now. And Andre looked at it and said, hey, I can go public and have all the responsibilities of quarterly reporting, super expensive D&O insurance, and about $4 million in extra costs on my P&L, or I can consider the private equity path and frankly accomplish everything I want and more and have an extremely streamlined decision-making process with a very focused board. And so his view was, this seems pretty easy, right? He was talked out of his IPO path pretty early. Now, so when we think about the investment drivers, their positioning for future growth was outstanding. The market was right. Their market positioning and maturity of product was excellent. So great one for us to come in. It's kind of you're jumping on a bus when it's moving full speed, and you just that's why you got to pay a lot for all the safety padding. It frankly already had an attractive financial profile, almost all recurring revenue, high 90s retention, great growth rate, and frankly, meaningful profitability. And so all those things make it an easy yes to get into. They had a very large enterprise customer base, and this is one where it's easier to, in some markets it's not true, but it's easier in this market to get big company enterprise validation to move down than it is to start small and go up. Not true in a lot of markets. It's sometimes that market movement is difficult to do. And then finally, they had a differentiated set of product offerings. In our view, it was better than the competition, and with some M&A, we could really make a big difference on that. We already covered the market leader point. So after Vista invested, we were able to do a few things that I think were very important. So the first was he decided that the team he had on the field was the wrong team for the next 5 years. Not something he had really revisited before because he was getting ready for IPO and he needed to tell a continuity story. But when he really looked in the mirror, his view was, great people got us here where we have our vision set on where we're going to be in 2 short years. We need to make some changes. And so they made the hard choice as a founding CEO to make those changes. It made a huge difference in the business. Second, he wanted to go buy Unbound ID. If he had been trying to go through the IPO process, 1, he wouldn't have the money to do it, and 2, he wouldn't have the ability to split his time this way. Very important M&A event. And 3, we helped him with a Microsoft partnership that puts him in a catbird seat, which will really help him, in my opinion, in the mid-market and down market by validation from Microsoft as well as the channel through O365. Second company is Granicus, and this is a different story. And so this kind of give you a little bit of sense as how Vista and private equity looks at a variety of different companies. The first one, outside of the enormous valuation, was an easy one, right? Who doesn't want to invest in a company like that, right? This one's a little different. So Granicus was a company that another private equity firm had built through and the acquisition of a number of smaller companies, consolidating, effectively think of it as a portion of the automation of the state and local government, right? Basically bringing it, with a focus on cloud, kind of communications to constituents and board meeting management and a variety of other things. And I'm sure Mark can correct me on everything I'm getting wrong right now. But it was a market leader in that business. And then at the same time we were looking at buying Granicus, another company that was focused predominantly on that outbound communication side called GovDelivery was available for sale. And our view was if you bought both these companies, the investment thesis curve bends dramatically in our favor. You take the two, because government's a late adopter in cloud. So if you take the two leading providers of cloud software for the government, bring them together where there's enough synergy between the ideas of what we can talk to the market about, bring in and bolster the management team so you have a company that is now a foundation. You've got a market lead from a size perspective, a broader product breadth, and a team that can go do a lot more than they could otherwise. There is an extremely broad market of other opportunity here to automate through the cloud, state and local government, right? And a lot of that will come through M&A, which is a strategy we in private equity would be very interested in helping. And so we saw that. So already a market leader. The mission criticality here is essential. And so you look at this and you say, retention rate is the key thing, right? So in paying kind of high 90s, 97, 98%, lost only retention. This business is also in the mid 90s, right? Very good, right? It speaks to the mission criticality. If you get it, it's hard to take out, and the alternative set doesn't compel you to do that. So that's super important. And the third thing was this rapid growth. The business was growing quickly. We believed over the course of the next 5 years, we could double the business organically. We also believed that there was a huge swath of products masquerading as companies that we could selectively buy over a period of time, further enhancing our growth rate and our the Oracle style account control eventually, where we're providing a little bit of everything for folks, which we thought would be really useful. And this too made a very attractive profile. When you think about the advantage here, there's a ton of time put into making these communication systems and software applications available from local government to their constituencies. And their alternatives usually involved a tremendous amount of people time. So we like the high ROI aspect, which attracted us here. Again, this business had an attractive financial profile. In this case, balancing growth and profits. I mean, our view is there's a research analyst that coined this, but we've now stolen as well, which we look at the rule of 40, or for our best companies, rule of 50, which is you take your organic growth rate of recurring revenue and add it with your EBITDA margin. And if you're 40 or 50, you're good to great in terms of your performance. And our view is we're comfortable anywhere, right? If you're growing 40, 50, 60%, we'll take lower profits. If you're growing 10%, well, we should probably be finding a way to get more profitability out of the business because the model has roughly shaken out there for the best companies. And this business had that nice balance of, call it mid-teens or higher growth and nice profitability with the business that was already put together. They had a very large existing customer base across the two companies, which always gives you an anchor to windward, because then now you have the ability in a slower market, if we hit a cycle, to go back to your installed base, which is the easiest place to sell if you're doing a good job. And then, frankly, we mentioned this already, is a robust platform for M&A, which in this case is an important part of our thesis as well. And so when you look at these two, both have a lot of attractive elements. These are kind of not two ends of the spectrum, because I think there's another end around the turnaround side, but that's probably the less exciting part and not relevant for you guys. This is kind of the profile that private equity gets excited about. So as you're thinking about building your business, and if you're going to say, hey, maybe the IPO isn't my thing, maybe I've built something that's really cool and awesome, but the strategic isn't quite knocking on my door yet. What's this private equity thing, right? The opportunity to sell all or some and ride the future on part of your stake, I think is an extremely compelling opportunity, particularly if you're not looking to retire. And I think what you want to do is say, hey, how does private equity look at these types of businesses so I can understand the choices I should make so that when the conversation comes and I'm looking to sell my business, you get top dollar. Because we're willing to pay top dollar because we know we have to. as long as the business profile warrants it. I do love this one that says that he's already organically doubled the recurring revenue. So I noticed the typo on that one. So Mark, we're going to hold you to that. It's already happened. It's good news. And that is it. A bunch of other stuff. But with that, I think we're running a little behind. So I think we can save questions for around the panel unless there's, and I'll be here for the networking event afterwards as well. But wanted to provide that as a little bit of a context on how we see software, the intersection of software and private equity, a bit of our perspective on Colorado, and hopefully use that to frame the panel discussion later with some great panelists. Thank you.
All right. Thank you, Alan. Appreciate it. Did we have any quick questions? We do have some time. We want to maximize Alan while we got him. So we can take a few.
Sure.
Anybody?
So the question was a little bit of a compare and contrast on what we see Austin versus the Denver Boulder area. I think it's a pretty good comparison. There are some similarities and some differences. The MSA, the Metropolitan Statistical Area, is a little bigger here, but order of magnitude, it's about the same. Edge goes to Denver in terms of population size and density. I think you guys have also a good university system that feeds in here, which is, I think, is essential for entry-level college grad hiring, which I think fuels these markets, which is great. I think it's a market that is gotten to be a very good place to recruit into. I think Austin's struggle was as recently as when I moved there 6.5 years ago. It was sometimes hard to get someone at a mid-level to move there because they were like, particularly if they're coming from Silicon Valley, because they're like, if this job doesn't work out, what's next for me? And they look around to left and right and they're like, well, there's like 4 other jobs and they're all taken. Maybe I should stay here where I think I've got 50 other jobs. So that was true then. I think that's less true now. And I would say we're probably at parity on that front, where I think it's a town that folks like to live in. There's a lot to do, good family town. I mean, these are all the important things that I think are generally positive for recruiting executives at that stage in their career. Senior talent has always been this has been a good market to attract senior talent into, just because because you're paying enough, frankly, to get folks to say, we'll go. In Austin, yeah, we had definitely a better barbecue. So I agree entirely. So I would say those are probably some of the biggest things. I would say from moving up the evolutionary curve of being strong tier 3s, I think both of them are. And I don't mean, and tier 3 is not a derogatory comment. It's like just where we are in our respective life cycles. I think they're pretty similarly placed. I think if one of them or the other had a really breakout company that then minted all the angels and whatnot, I think that would change the trajectory. Outside of that, I think they're both on a very good positive slope for the right reasons. I don't know if that helps a little bit.
Talk about machine learning, AI versus the others. Sorry. Hi. Name's Tony. On your slide 8, you talked about AI and machine learning as well as the other components in technology. How much weight do you provide to AI and machine learning versus the others like SaaS today in the next couple of years? What do you see?
Yeah, it's a great question. It's something we're investing in heavily. So inside of our captive consulting practice, we've hired 7 data scientists and high-end machine learning experts inside a private equity firm. So I know we're the only firm that's done that. And the reason is we believe data and the insights from the data are going to be more important in 10 years than the software our companies sell today. Right? And it's going to be as dramatic as you give away your software to get access to the data to sell back the insights to possibly the same or different customers. Right? So we believe in that as a long-term trend. Whether it's 5 years from now, 10 years from now, 15 years from now, we're making a big bet, because these folks aren't cheap. It's both. So we use it. It's a good question. We use it for both looking at new deals as well as helping our current portfolio. On the data side, I'll give you a slightly longer answer than just that. I think it's useful. So on the data side, most of our companies are not prepared to even have legal access to their data, much less know how to monetize it, right? So there's, in our world, there's kind of a 6-step process to getting to where you can really monetize data. And the last one's the most important, which is, do you have a business case for someone wanting to pay you for it? The first one is, can you get access to the data? Do you have the legal rights to it? Is it ambiguous? You know, how do you get it normalized into a usable fashion? Or is it gonna be something you can sell back to your current clients in a consumable format, starting with benchmarks and maybe other things? And then on top of that is where machine learning comes in. And so machine learning is not a new concept, and it's been around since I was in college myself, and my degree program intersected it a lot. But computing power sucked back then compared to what you need to do to really take a big data problem. And so what we look at it as is we were trying to lay the foundation and the DNA in our companies much around getting ready so that they can use the data effectively, and then where appropriate, understand where we can actually use machine learning to advance during our hold period, frankly, the value add to our customers by using it. And I would say, and this is super anecdotal because I only do about 1/3 of the business that we see. Most people that tell me when we go into a new company that, oh, we've got AI and a lot of great machine learning, it is complete bullshit. Sorry. And they don't. They basically maybe have some simple rules and whatnot that are, they're not bad. They're just, it is not machine learning. The machine is not making itself smarter. And there's a lot of, variation and gradations of what that means. But, we see the promise of it. And there's a handful of companies that we're actually in the middle of working with right now that we think do a great job of it very much on the forefront. We're trying to invest in a couple, mainly because we think that as a firm is going to give us the best acceleration in what we can do for the rest of the portfolio.
Yeah, we can do one more.
Oh, sorry, Sam was first.
Perfect. Samuel Thomas, LA, coincidentally, co-founder of the database company. So going off of the data play, how does that affect your decision making in investing in a company that you have a data model and makes data easier for those data-driven decision making? Even on valuation, how that might affect valuation?
So the question really revolved around how early stage is the business?
Seed. So
seed.
Early stage, but relating back
Yeah.
to your work,
Yeah.
you're looking at that and see it's really important with your words. Data will be more important than software in the next 5 to 10 years.
Yep.
When it comes to data breakthroughs, how important is that?
So the question revolves around, how much value are we going to place on basically the elements of data preparation in the company. We're looking for their own business plan and monetization, extremely high. And so if someone is monetizing it already, we will pay for that, right? And because you've gotten past all the hurdles, right? You own the data, you have access to the data, someone's found value and they're paying you for it. Now to go to market, and can we get everyone else to do it? We own a few companies that are straight up data companies. We own a company called Ag Data, which I'm sure you could guess is an agricultural data company, cleverly named. But what they do is and it's interesting. They are a data and BPO company that we bought exclusively because of what they can do today and in the future. And they basically take, and this will give you an example of how we thought about it. But we basically bought in a business that the core of what they did was they worked with the big input manufacturers to help get point of sale data from retailers and distributors from like 10,000 different spots farmers will buy seed, crop protection, and fertilizer, right? Crop protection is a fancy word for pesticides. And trace it back. And if you're a farmer, where do you go to buy super heavy stuff? The closest place to your farm. But I've negotiated a deal with Monsanto that if I buy your Roundup resistant wheat and your Roundup, which is now off patent, but the seed is not, I'll give you a 20% discount on everything if you buy enough volume. But now I got to keep track of it. So the old way to do it was you basically keep your receipts, and you put them in an envelope and you mail it in, and they'd open them up and they'd look at them all and whatnot. And that is a terrible idea in this day and age. And so the innovative folks at Ag Data basically built a very small piece of software. So the software piece is small to sit at the point of sale, collect that data, and send it back to Ag Data. Now, every retailer and distributor has a different format, different naming nomenclature, different file structure, and so it is a nightmare, right? So which is why we get the pleasure of doing it for a fee. And we take that all in, and we normalize it, and we basically help them pay appropriately the rebate programs. And it's multi-billions of dollars we pay out. Our estimate is the rebate checks we cut to the distributors and the retailers is in excess of 100% of their net profit as an industry. So the rebate program is on, if they didn't do the rebate program, they would be insolvent, right? And so it's super important to both folks, right? Which is why they do it. We basically facilitate that process, but the crazy part is we actually collect and normalize and have, you know, literal physical access to all the data. We haven't figured out how to help our customers do a whole lot of other exciting things with that. So that business was acquired in part, paid a little bit more for it because our view was if we can help with the next layer of breakthrough for our client and their customers, wow, that's an exciting opportunity for both. And we did pay extra for that.
All right, we could do one more.
All right.
Got a quick one? Front?
All right, sorry, we'll talk later, sorry. We got one in the back, standing up.
So, you mentioned clean identity, and they were kind of looking at an IPO initially, and then decided to kind of go with private equity. At what point do you think it is good to start thinking about that transition and that change? You know, big stars in the IA want to pursue that IPO. How far along that road do you go before, you know, private equity may not be as attractive? How much do you invest, or is any time a good time for private equity?
Anytime's a good time for private equity, for sure. Buy that man a beer. No, it's, you know, and actually this, I don't know the exact details. I presume they'd already written their S1, right? Because you have the confidential filings now. We run into a lot of companies that will go through that process. They've got a S1 on file, and then they start weighing their options. They start getting market feedback from the public markets, and they look where the private market valuations are, and they're ready, and then they make a call which way to go. Now, I will tell you, if it was me, you know, in our history, in 17 years, we have never had the need to take a company public. We've been able to find liquidity 100% of our exits without having to go public. And I look at it that way. We look at it very much as, you know, we don't have to go public to find liquidity. We don't need to go to the public to say, hey, hopefully, you know, Merrill Lynch will find us a bunch of folks that want to, you know, buy our shares in very small fractions over time. So I think it's always a good opportunity, and I think, you know, if you're going to go public, and I think there's a number of our companies that do consider it, you know, you got to have, I think, a very clear reason why you want to be a public company. You know, too often I'll meet someone that says, I want to go public, and I'm like, why? Well, isn't that what you do when you're a successful venture-backed company? I'm like, time out. Like, that's not a dimension of decision-making that should factor in. Or it's, frankly, ego-driven is probably the second biggest reason I hear. It's either no reason or it's ego-driven. If you want to go public and you need the public currency to go make M&A happen, and that's a legitimate reason. If your brand, being public is important to your brand and how people look at you, sometimes that's a great reason to go public. If you're growing so fast that the market is going to give you a 2x valuation over what the private markets will give you, and you think you can sustain it to where you get some liquidity and can take advantage of it, you should go public. If those three things are not true, I think it's 90% chance going public's a mistake. All right, I'll be around later as well.
Let's give it up for Alan.
Thank you, guys.